Welcome to The Explainer. Today, we're digging into a story that spans nearly 100 years of American history, but we're not going to look at it through the lens of wars or presidents. No, we're going to look at it through something that affects us all, every single day: money. We're going to see how the sheer amount of money in the country fueled incredible booms, sparked devastating panics, and ultimately built the financial world we all live in right now. So let's start with a really big question. How can the total amount of money floating around in a country actually shape its history? I know, it sounds kind of abstract, right? But the answer is written in the incredible highs and the absolutely crushing lows of America's past. Believe it or not, our main guide for this whole journey is this one single chart. It tracks the total stock of money in the US all the way from 1867 to 1960. Now, it might just look like a simple line on a graph, but every single peak and every single valley you see there, well, that's a story of national crisis, of prosperity, or of a fundamental change that echoed for decades. Okay, so before we can really start to unpack the story that line is telling us, we need to get on the same page. When we talk about the stock of money, what are we actually talking about? What does that even mean? It's actually pretty simple. It's the sum of two things: all the physical cash, coins and bills, that the public is holding, plus all the money that people and businesses have stashed away in bank deposits. Now, what's really crucial to get here is what this number doesn't include. It leaves out any money held by the banks themselves or by the U.S. Treasury. We are only focused on the money in the hands of the public. And if you look closely, you'll see this chart actually has layers. That bottom line, line A, that's just the physical cash. As you move up, each line adds another piece of the puzzle: checking accounts, then all deposits at commercial banks, and so on. But for our story, we're going to keep our eyes on that top line. That represents the whole shebang, the total money supply. All right, let's dive into the first major chapter on our chart, the late 1800s. This was an incredible era of industrial growth. Things were exploding. But it was all built on a financial system that was just incredibly shaky. It created this boom and bust cycle that must have felt totally out of control. So what was the problem? Well, a huge part of it was something called the gold standard. The idea was to create stability by tying the dollar's value directly to gold. But what it actually did was make the money supply super rigid, almost brittle. See, as the economy grew, it was thirsty for more money to keep things running smoothly, but the system couldn't expand to provide it. The whole thing was basically a financial tinderbox, just waiting for a spark. And that tinderbox, it caught fire. Again, and again, and again. The system's rigidity led to this recurring nightmare: the banking panic. You had huge ones in 1873, 1893, and 1907. And these weren't just small downturns. No, these were massive, nationwide crises that bankrupted countless businesses and just wiped out the life savings of ordinary people. The source material really highlights how these things would just spiral out of control. It all started with fear. A rumor of one bank failing could create a domino effect. People would panic and rush to pull their cash out, not just from the bank in trouble, but from perfectly healthy banks too. And to stop themselves from bleeding out, the banks would just slam the doors shut. They'd stop giving people their money, which effectively froze the entire financial system. The Panic of 1907 was the last straw. It was so bad, it brought Wall Street to its knees. And after the dust settled, pretty much everyone agreed the country just could not go through this again. Something big had to change. And that big change came in 1913. Congress created a central bank, the Federal Reserve. Its whole mission was to finally bring some stability to the system. And most importantly, it was designed to act as a lender of last resort, meaning it could provide emergency cash to banks to stop a panic in its tracks before it could spread. And for a little while, it seemed to be working. The new system helped guide the economy through World War I and the big boom of the Roaring '20s. But the Fed was about to face the single greatest economic test in American history, the big one, the Great Depression. And this right here, this gets to the absolute core of why the Great Depression was so devastating. You've got two things happening at the exact same time. On one hand, the total amount of money in the system is absolutely collapsing. And on the other hand, the public's desire to hoard whatever physical cash they can find is skyrocketing. It was the perfect storm. As fear took over, money just vanished from the economy, starving it of the oxygen it needed to survive. And the scale of this collapse it's just hard to wrap your head around. Between 1929 and 1933, the total amount of money in the United States fell by a full 1/3. Just think about that. A third of all the money in the country, gone. As the source notes, it was the biggest, sharpest monetary collapse in the entire 93-year period, a failure on a scale that was just unimaginable. And that brings us to the most brutal irony of this whole story. The Federal Reserve, the institution created for the sole purpose of preventing financial panics, ended up presiding over the absolute worst banking collapse in the nation's history. It failed its single most important test, completely and catastrophically. And the most tragic part of all of this? The source material makes it painfully clear. It was preventable. The Fed had the power. It had the tools to pump money into the system, to stop the bleeding. But for a whole host of reasons, internal paralysis, a stubborn refusal to let go of the gold standard, it just failed to act, at least not until it was far, far too late. But out of the ashes of that catastrophic failure, something new was born. The Great Depression wasn't just an end. It was the violent, painful beginning of a whole new financial order. In response, this massive wave of reforms completely changed the game. To kill the fear of bank runs once and for all, the government created Federal Deposit Insurance, the FDIC. To give the system more flexibility, the U.S. finally walked away from the gold standard. And the Fed itself was totally reorganized and given even more power, kicking off the new era where the government would play a much more active role in managing the economy. And we can see the results of all this right back in the data. Just look at the dramatic surge in the money supply that was needed to fight World War II. And then, look at what comes after. A period of managed growth and stability that was just unthinkable in the decades before. Those violent boom and bust cycles, they were finally tamed. So when you look at this entire 90-year story, the big takeaway is this. Our modern financial system wasn't designed in some quiet academic setting. Not at all. It was forged in the fire of one crisis after another. It's a system that was literally built on the painful lessons learned from bank panics and one catastrophic depression, with each disaster paving the way for the framework we all rely on today. This journey from the Civil War to 1960 shows us just how radically our financial world can change. The system evolved from one based on physical gold to the complex managed one we have now, and it leaves us with a huge question for our own time. What forces are shaping the next monetary system? Is it digital currencies? Is it AI? Global debt? What's going to be the defining monetary challenge of the next 90 years?